Hello, everyone. Welcome to today's session. Let's get underway here, and we'll start out with current market conditions, long-term perspective, as we always do. Remember that we're focusing on a top-down approach, which is overall, what is the market conditions doing in the long term? What are they doing in the short term? And how do we position ourselves in terms of position size, number of holdings, and stop loss locations for those market conditions? Do we have a certain number of equities, certain percentage? We'll talk about that a little bit more today. Also going to go through this process kind of from top to bottom, and we'll go through and set up a trade and then show you a couple of functionalities in Webull. I'm going to use some of those Webull examples a little bit more, which are some of you are finding helpful if you don't have a brokerage account to be able to set up some of the trades that we want, and then managing those going forward. So current market conditions, we're sitting right here at a bull market rank. We're bullish in a bull market. Essentially, that means that we are, in a lot of cases, it's not exactly, but in general, we're looking at what is the long-term trend of the market as a whole. So if we're looking at S&P 500 and we're bullish in a bull market, we know that we've got a long-term trend up, a short-term trend up, and we're inside of the buy zone. So when we're looking at those bullish market conditions, versus if we were bearish in a bull market, that's just a pullback. It's a retracement in the overall uptrend. If I were to drag this back, if we went to the 1 year time frame and I were to move this back just a little bit to where we were at that point in time in the S&P 500, okay, this is bearish in a bull market because we're in a bearish short-term trend. We're retracing that trend, and the trend is down. Okay, but overall, we're still in a bull market because we are still in this overall longer-term uptrend, and that's going to be, that's the real basics of it. There's a little bit more to it than that, but in terms of understanding what it's looking for, that's all we're looking for. Is we want to realize that it's a pullback in a bull market that might provide buying opportunities. It might not. We don't necessarily know, but once that starts to shift and start to get back up, then we start to get back to bullish in a bull market. This is really where we want to start engaging again in the market activity, and that can also retrace back down again. So then we have this retracement, and then this is essentially where we're at as of today. Okay, that's the 1 year time frame on S&P 500. So that's our perspective. That's our bias as we're going into a trade or adding new positions to portfolio. We've got to ask ourselves, where are we at in this trend? Are we deep into the trend? Are we early in the trend? And then also, what are some of the economic conditions that are at play? We'll come back to that because I like to use the bond yield curve as well. So in the short term, 1 year time frame here, in order to utilize this, really, sometimes it kind of feels like just a choppy mess right here, and sometimes it is. But essentially, it's just taking all three of these components: sentiment, breadth, and momentum, and combining them all into one chart, so we can kind of get an idea of where are we at in all of these three happening together. Are we at the lower end of the range, or are we at the upper end of the range? We know that we're at the upper end of the range, but we've been consolidating a little bit right here as well. So oftentimes what happens is we do get we get sentiment that starts to weaken, and then we get a momentum spike, and that could start to happen right here in terms of a spike higher in price activity and momentum, but sentiment is lagging and breadth could be lagging here as well. We're not quite there yet, but that often indicates some fear in the marketplace, and that some of the larger institutional participants are starting to sell into the strength, and we start to see that with that blue line starting to show some weakness right here, and that's found down here at the bottom. Okay, and so we can see that, and oftentimes it'll stay in the upper end of that range. It'll stay really bullish for most of the trend, most of the bull market, until that starts to shift. When it starts to shift, it sells off pretty quickly. I've mentioned before, it's related to VIX, so it's related to put buying, institutional put buying, and institutions will hedge a downturn by buying puts aggressively, and that'll move the line right here. That'll really start to move that. So when we're starting to just glance, really the biggest thing to be looking at is this number right here right now, and that is we're at 25 in terms of this momentum. That's proven to be relatively sustainable, but it's not going to be sustainable for long. And so that can also allow us to say we're at the upper end of the range. We're at the supply side of the trend, meaning that there's probably not a lot more demand, aggressive buyers coming into this trend at these levels. They certainly could be and continue to allocate towards that. But as far as fresh money moving somewhere, moving from cash into stocks or moving from bonds into stocks or moving into something into stocks, most funds or most institutions are probably pretty fully allocated at this point. And now we're looking to the other side. At what point are those guys going to start to sell, and why? We never know the why, but we certainly do know the fact that they're priced. They've had a nice run into the strength, and adding aggressively into more bullish positions is not a high probability at these locations. So that's just that quick perspective. We also see some weakness happening here in breadth. So again, we've been relatively sideways in the last few weeks on the S&P 500, and that could continue to be the case right here. Bond yield curve, this is that longer economic term, even economic perspective. The bond market is a good place to look because we are always dealing with the Federal Reserve, and we're always dealing with interest rates that create liquidity for economic participants. Liquidity meaning, can I borrow the money to grow my business, or can I borrow the money to buy a house, or can I borrow the money to buy a car? Okay, that creates liquidity, which creates price movement or lack of movement. So if there's no liquidity and money is tight, it's harder for the economy to grow. And that's the point. That's the point that the Fed likes to make when they play with these interest rates is and they're also dealing with inflation. So inflation, when prices get out of control and there's too much money in the system, then ultimately it creates inflation. And the Federal Reserve we had up to 8% inflation. Their mandate is 2 to 2.5% inflation, and they try the levers that they have to control that inflation. The only one that they have are interest rates, and so they deal with the Federal Reserve funds rate, the Fed funds rate, and that has more to do with the ability for banks to borrow money from the Federal Reserve at a certain interest rate. And so it filters down to the banking system, which ultimately filters down to companies and filters down to us as consumers. And whether or not, like right now, the housing market has been really hot, but the housing market interest rates are high. So it's going to start to slow that hotness a little bit, or should, unless the economy is really good and consumers still have the ability to borrow money. They're still making enough money to pay for a $600,000, $700,000 home with 5% interest rate. That's hard to do. I don't know too many people that are actively buying really aggressively, but a lot of people have to do that. We have to have a housing, and the prices are just what they are. And so it'll be interesting to see what ends up happening. But this is an interesting thing because I've mentioned this before. The bond yield curve, typically, a healthy bond yield curve looks like this. Okay, this is a normal looking bond yield curve where we have lower end, shorter end of the yield curve, shorter interest rates are paying you less money than longer term interest rates. 30 years paying here, 3 months are paying here. That's a normal yield curve. Okay, and it happens when the economy is set for a little bit more for growth. Okay, or it's been struggling. Okay, and the Fed is what it is. We have to deal with what we have to deal with. The rules of the game. We have to play by the rules of the game. The rules of the game are the Federal Reserve controls everything in terms of liquidity and money supply. So we've got to pay attention to that game and realize what that could do to the economy, and then try to position ourselves in ways that allow us to either profit or just stay safe. Okay, and that is moving money to cash. Now let's look at what's happened. Okay, this is going back to 2000. So we had the dot-com run up. We can have inverted yield curves for a long time. This one lasted, or this flat yield curve. This went from 98 essentially to 2000. Okay, so we were and then we really got weird right here in 2000, and that's when it started to get the retracement back down. We had the internet bubble, and then we get a healthy yield curve. We get a run back up in equity prices again. We didn't get inflation right here, but we did have the subprime debacle, which just about broke the entire banking system. And so then we had this collapse, Lehman, Bear Stearns, some massive failures, and back to a healthy yield curve. Now, we end up getting up here with COVID. Look what happens to yields. The Fed is giving money away. Okay, they're literally sending us checks in the mail, and they obviously have to borrow that money against, and create a scenario for us as consumers and businesses to go spend and get money super cheap and super easy, because the economy was slowing. Okay, so in this case, what did that do? That's just pumped the economy full of a ton of liquidity, tons of liquidity chasing fewer and fewer goods and assets. That creates inflation. Now they've got to break the inflation by keeping interest rates high once again, which they do, and now we are where we are. Okay, so now how are we going to go forward with that, knowing that the two games are inflation, number one, which has come back down. There was a number this morning that came out which is a little bit hotter than expected. It was a CPI number, but it's still we're still under 3%. So we're not bad, but now we've got to see and last week we got an economic an employment number which was really good. So they call that a soft landing, and that is if the Federal Reserve can raise interest rates and essentially break the economy, slow the economy without breaking it, I should say. Slow it without breaking it is considered a soft landing instead of a full-on hard landing. My experience, I started right about here, is that they never quite get it right, and market participants are usually all over the place with that. But we'll deal with what we're dealing with right now, and that's all we can deal with, and that is we still have short-term rates higher than longer-term rates. That's got to correct itself. The Fed needs its numbers to come in where they're seeing the economy growing at a normal rate, not fast, not slow, and they also want to see those inflation numbers staying where they are to slightly lower. So the part of the risk, and the bond market is getting pummeled, maybe not pummeled, but it's affecting the bond market here in the short term, some of these numbers, because now the stock market is thinking, the Fed can't cut rates, right? Because the economy is still too hot, which still might create more inflation. And so the bond market is saying, Fed, you're not done cutting rates, because now when bond markets are moving lower, interest rates are moving higher. Okay, so all of this affects equities in the longer term, not so much in the shorter term. But that's kind of the stance that this perspective gives us. Our number one, long-term market stocks have been moving higher. We've been moving higher in anticipation of lowering Federal Reserve interest rates. If without breaking the economy, if that doesn't happen, then stocks, or if they have to continue to keep rates high, that's probably going to hurt the economy. Stocks are going to sell off. We haven't seen that yet. So the market doesn't believe that's the case quite yet, and it may not be the case, but that is one of the things to be aware of in terms of how the two are working together. What are stock prices doing in relation to the bond market? Always keep an eye on what the bond market is doing, because as I mentioned before, that is really what is controlling everything. It's controlling the money supply, it's controlling the liquidity, it's controlling how much money is moving and where and to who or to whom, and that's it's an interesting perspective to be aware of. Now, that being said, let's jump in and look at market conditions. We still have S&P 500 holding nicely above these levels. Had a breakout point, small little indecision candle today. Really not a whole lot happening, and that's okay, but that's where we're at in current market conditions on S&P 500. We're also looking at the Dow Jones, which also had a good solid move up yesterday, 300 points or so back into momentum. Really solid support right here. Look at all that support. 1, 2, 3, 4, 5 solid days around that 418 level on DIA. This is the ETF, Exchange Traded Fund. So if you want to buy the Dow Jones Industrial Average entirely with one stock, then you would own the DIA. Okay, and I don't know why we always say the Qs, or the DIA, or the SPY, but it's just kind of the lingo that ends up flowing out of some of this terminology. SHY sitting right here on a retracement. That's the short end of the yield curve. That's the short-term bond market, and we're seeing that here on SHY. Now, some of the sectors, let's jump and look at those. We are seeing the sector perspective, which is helpful for breadth. Do we have a really strong uptrend with every sector participating? In this case, we've got most of these which are in the uptrend, and we've got some that are in the holds, and then some sells. So really kind of a spattering of sectors that are doing well, some not doing so well. Commodities, gold has been in this nice uptrend, having a little bit of a pullback right here. We're also seeing SLV, which has had a decent retracement back into that 382 level. And we're also seeing USO, which is working on an uptrend, a big rally here today, 3%. So we could see some continuation when we start to see a stock or a market or a sector that moves back into momentum, has a good strong move, and then pulls back, and then you see new demand and buying back into that. We could start to see a shift back from that downtrend back into bullish momentum on USO. For whatever it's worth, okay? Oil is always an interesting commodity to look at, and if you want to buy the commodity itself, then you would just buy USO, which is the ETF. Let's jump over and look at a couple of stocks here and go through a couple of examples. In the new buy list, let's just scroll through some of these and see what's been moving today. And again, this is kind of the process. I'm doing it a little bit slower, but you can do it certainly faster to say where are we at in the market trend, where are we at in the kind of the economic perspective with interest rates, and where are we at with commodities, where are we at with sectors, and now let's drill that down and say where are we at with individual stocks. So we can start here and go into this new buy list. Again, some of this, if you don't want this new buy list, this is relatively broad. Okay, so if you scroll down to the bottom of the new buy list, it'll tell you what the scan criteria are. New buys, $2 or higher. It's had a hold rating, meaning it's non-trending into trending. It's going from non-momentum into momentum, which is that buy signal. A rank of 70 or higher, and it's got an average volume of 100,000. That creates a lot of names. Okay, on a good bullish market uptrend, it creates a lot of names. If you want less names, then you've got to scan those out and filter those out by using this. So you could go into your new buys. This is one I have called New Buy Large, which is basically all the same criteria. I've got a signal, and the scanner will just automatically give you that adjustment from hold to buy. So you're going from trending to non-trending. But then you can filter out some of the other things. Say, I want bigger companies. I want more volume. That's going to help produce a little bit more quality names. You can add earnings in there as well if you want. But in this case, that's going to give me this list of stocks. ARM is one of them. Spotify, which is getting a move. This is the one I wanted to focus on today. Retracement, pullback. So at the market open, remember, we obviously know what's happening today, but if we go back to if this were this morning or the end of the day yesterday, and this is an end of day system and part of the reason why is because it's forcing you to follow a structure. You can't click off of the daily chart and go to the weekly, or you can't click off the daily and go to a 5-minute chart and say, what's happening intraday, tick by tick. Okay, so that in most cases, there's lots of other services that you can go do that in, but is it helping or not? Okay, so this is just providing a framework. It's providing some structure so that you don't go do that intraday, or you don't go do that and look at the 5-minute chart and say, oh my gosh, I'm getting close to my stop. I'm just going to sell. It creates a little bit more slower process, and that's really what we're designed to do, is just slow down the process to a daily time frame. That's more than enough time to get in a nice, good trend and be able to participate in some of these stocks that are moving higher. I mentioned in the last update that ideally this is what we want to see. We want to see a stock that's already moving this direction. And then we give this amount of range. And most of the time you can do this on any of these time frames, 3, 6, 1, or 1 year. Okay, all that does is just changes the perspective of trend. So if I went out to a 1-year time frame, it's going to grab the full trend. Okay, so look where the 236 is now on the 1-year time frame. So if you really want a lot slower perspective and a little bit more range, then you can look at that 1-year time frame. And sometimes it's just too much. And sometimes the 3-month is not enough, although that 3-month is usually pretty good as well. A 6-month kind of the sweet spot, and gives us, for the most part, the timing and the trend and an analysis that we want to be able to focus on here as well. So from here, again, I've got to determine based on my trading plan and my analysis, how big of a position size do I want to take? If I'm going to buy, I've decided I like these market conditions. I want to buy into Spotify at this current market price. Well, how many shares can I buy? And then where should I protect my initial risk capital with my stop loss? So I go over here to my portfolio. I've determined, okay, in this case, it's a $100,000 roughly portfolio, and I'm using 2 to 2.5% position sizes, a $300 stock. So let's start out with 10 shares, see what that looks like. I might not be able to buy very many here. 2 shares, 3 shares. Let's go 6 shares. That looks like it's going to be that number. So 6 shares of Spotify puts me at 2% portfolio at risk. And that's inside of my structured trading plan to say that's the amount of risk I'm willing to take on a position level. The position level is the entire size of the transaction. That is all 6 shares at $381. That is the position size part of this equation. The second part is I want a stop loss with that, because I don't want to risk, obviously, the entire amount, nor do I want to wait and have a deeper retracement and then have to wait for it to turn back into the trend. It's either going to continue trending higher or it's not. Okay, that's the only game I've got to play. It's either going to continue trending up, or if it's not. Well, if it's not, what do I do? Okay, well, we want to have a stop loss in place to say at some point it's going to stop trending. I don't want to keep holding it if it's going to move into a either non-trending, or most of the time, even in a hold, which is non-trending, we'll continue to hold on to that. But if it reverses all the way back into a downtrend or below a certain price point, then I want to make sure I'm exiting out of that trade. So let's place our stop. Usually that stop loss, a location. Stop losses can be a good point of discussion, because you get a lot of discussion about stop hunting algorithms, where you're getting market makers that are out there looking for certain locations, and it's an absolute reality. The reality is we are playing with the big boys when we're buying and selling stock, and they are professionals. They are looking to make money off of every single tick, and if there's an opportunity for somebody to buy at a place that you're willing to sell, which is a stop loss, then they may go trigger those stop losses if it's really, really close. But for the most part, on a really active company like Spotify, it's got 1 million shares on average trading. You're not going to get somebody that can push the market hard enough in one direction just to stop out our 6 shares. Okay, so it becomes one of those conspiracy excuses to say, I got stopped out because these damn market makers, they're just out to screw me over. Well, not for 6 shares, they're not. Okay. The reality is there's a whole bunch of shares that are sitting right at certain levels, and it creates liquidity for larger institutions that are looking to buy. And so sometimes we just prematurely get stopped out. On some of these bigger, the larger the volume, the less risk of that happening, because you can't have one player that's going to go, hunt down our 6 shares and stop us out. But if it's close, it's going to get lumped into a larger order as well, and it's just the risk that we have. So if you don't want that risk, go with a way deeper stop loss. Okay, if we were to do that, let's look at that. Let's look if we had a stop at 342. It's kind of pointless, honestly, because our goal is our goal, and our goal is to get out of a loser at a certain price point. Okay, so let's stick with this 360 range. That 382 is at 360.56. Let's just call it 360. 360 puts us at 0.11. That's really tight. A small amount of risk, 5% retracement, 0.11, $130 at risk for a full position size of 2%. That's great. If we can take that and we get it, then why not? Let's keep our risk smaller. That means our reward to risk could potentially be really good for this kind of a stock. If we said, I don't want to prematurely get stopped out, so let me make sure I'm going deep enough down inside of that next rung in the ladder, that support zone of 350, let's say 350, and then I'm still pretty light on that. It's only 8% away. So I could say, yeah, okay, let's stick with that. Let's stick with the 350 stop. That way, if it's close enough and it comes down and kind of kisses this level and hugs it, and really there's risk for me to get stopped out at 360 and I want that, let's go to 350. And then that gives us a little bit more room. It also increases the potential risk of, if it does break down, we get stopped out. We could have gotten stopped out at a smaller price and lost less money on that trade. It's pretty easy to set that up and see that process. So let's jump over now and say, okay, I'm going to buy 350, buy 6 shares at 350. Okay, now this is where I wanted to go into Webull a little bit here, because on this functionality, and I've covered this a little bit more, but let's go back to, oops, that didn't pull that in, Shopify. Okay, so here's the setup on this perspective. It looks that doesn't look the same. Oh, SPOT. Shopify, not Spotify. SP. Okay, there we go. That looks better. Okay, so our price location here, we didn't have this bar, obviously, so we're sitting right here. This would have been as of this morning. So when we're setting up this trade, we could say, I want two things to happen. Number one, I want to know a limit price, which is the price I'm not willing to pay anything more than, and then I want to have my stop price. If we're setting it up pre-market, then we need to have both of those pieces of information. Let's just increase this size. Now, there's several ways you can do that, but one easy way is just by using this chart trader. And so we said we're going to do 6 shares. Okay. 6 shares. Now, one of the functions here is one trigger stop. These are easy to do because it makes setting up the order nice, because I can click on buy. Okay, now my mouse is going to be dragging over this, and it's going to set up my limit price. This is an opening before the market opens. Okay, and so we know that we were right around pre-market. We can look at the pre-market price. If it's less than a reasonable amount, if we see that it's gapped way up here to 400 pre-market, we don't want it anyway. We need to reevaluate. But if we're close to what we want, we can set it here at a reasonable price to say, I'm willing to pay, $378 or lower. Okay, now when I click that one time, it automatically, I can drag to my stop loss location. And we said what? We said 350. I'm willing to go all the way down to 350 on my stop location. Okay, and you can see how far away that is from our entry. That's 349. Let's just call that 350. Now I can drag to the upside as well. This is called a bracket order. And my bracket order is going to say at what point on the upside do I want to sell. So if all you did is say, I'm going to buy 6 shares. If I'm wrong, I lose down here at 350. If I'm right, I win up here at 420. That's called a bracket order. And now I could simply place my order and it's automatically set up so that is set up. And I don't have to do anything else. Okay. If that's my goal and that's my plan, I either get stopped out or I have a winner. One or the other is going to happen. And I don't have to think a whole lot about this from here. Now, that's typically not how we exit trades. We typically will exit trades at a certain percentage of that moving higher. So we can do a couple things. In the order entry, you're going to have, once it's set up, you can change the number of shares to say, I want to sell, instead of 6 shares, only 1 share at my profit target once the order is set up. But as of right now, it hasn't purchased any of these yet, but I could change those later on in my positions, or I could just get rid of it, which is typically what we'll do, is just get rid of it for now, set up your stop order, have your buy order, and now when it fills, it's automatically going to set up your stop order for you as well. And then from there, once you're in a trade, you can drag that stop loss higher. Okay, it's going to show you where it's at on your chart. All you got to do is click it and drag it higher or lower. Very easy to manage. Most brokers now are pretty similar as far as being the functionality, but I like this format. I like the charting features anyway, and It's really easy to use. It's super easy just to go in and click it. I like it clean like this. I like the order. I like the stop loss. I just want to, now ultimately we're trending higher. We're moving higher with that price activity. And at some point, it's going to stop trending higher. Okay, this is PLTR, which we got in. This was our order price back here at 29 on an entry, on a buy confirmation bar back here, and we actually have sold twice, once here and sold some more this morning because that was up 50%, and we sell at 25% and at 50%, and now the remaining shares are going to be just trail. Let's trail the rest moving higher. We'll update that stop loss here soon. But that's kind of the process to go through, finding the trade that you want, finding the market conditions. Are they acceptable for you to make a trade? If so, how many shares are you going to buy? Then where's your stop loss? Then how are you going to make the order and why? Okay. And then what are you going to do once you make that order? You should do nothing. Okay. Just check it every morning. See if you were stopped out. If you need to make an adjustment higher, make that adjustment higher on your trailing stop. But this process should set up your order to the acceptable range of risk in advance so that you're not having to pull out your phone every 10 minutes and say, what's happening to my trades? Okay, if that's the way you're trading, then this is a different methodology for you. This is way, way slower. It's yes, we make a lot of trades, or I should say we're entering a trade often, a new stock trade often, but we're not managing that stock trade tick by tick, second by second. We want a little bit slower process so that they're still trades, but we're focused on a slower management tool as far as the portfolio process so that we're not having to be glued every second to every position that we have. And then once we get in there, we want to have our positions on our portfolio management so that we've got some of these, so that everything is set up in advance. Okay, we've got our stop loss listed here. Here's our entry. There's our stop. Here we've got our entry. We've got our stop. And then as we're moving higher, all we have to do is go in each morning, check to see where our stops are at, and do we have gains enough on some of these to be able to take some off the table. COHR, we're up 20%. And so we just sold the other day 25% I might have said those backwards, but we sell 25% at 20% increase, and we sell another 25% at 50% increase. At least that's the market conditions. That's what we're doing right now. You can always change that to sell a portion at 10% or sell a portion at 15%. And that allows us to take some money off the table, take some profits, but still have the bulk of the position for more upside. And if the entire position reverses to a stop location, then we get stopped out of the entire position. That's really kind of the core of portfolio management and an idea for you to be able to utilize with Webull. I'm going to end on that note and appreciate everybody's time and effort today, and we'll see you next time. Thanks a lot. Bye now.